Hello. We are going to look past the glamour of entertainment industry and examine a fascinating financial paradox. We will analyze how a project can generate nearly $1 billion in revenue, officially report a massive financial loss, and what this means for financial transparency. In 2007, Warner Bros. Released Harry Potter and the Order of the Phoenix. It grossed 938 million globally, yet a leaked financial statement revealed the studio claimed the film suffered a 167 million net loss. How is this mathematically possible? The answer lies in corporate structuring. For major films, studios create a temporary subsidiary company, a special purpose vehicle, or SPV. This separate entity isolates risk, but is also used to absorb arbitrary expenses, so the film never officially saw a profit, effectively zeroing out the payout onto actor and writers. Let's look at the journal entries from perspective of this film subsidiary. First, the parent company Warner Bros. Funds the production. They don't treat it as standard equity. They treat it as interest-bearing loan to their own subsidiary. To record a 150 million bucket, the subsidiary record a debit to film assets for $150 million, a credit to intercompany loan payable for $150 million. Our accounting equation balance asset increased by 150 million and liability increased by 150 million. Next, the film is released and is a massive hit. The subsidiaries must record support office receipts. We record a debit to card for 938 million, increasing our assets, a credit to post office revenue for 938 million, which increases our equity. If the accounting stopped here, the subsidiary would show hundreds of millions in profit. But here is where the Hollywood accounting magic happens. The parent company charges the subsidiary exorbitant fees for services it provides to itself. For example, Warner Bros. Charged the film 212 million distribution fee, so we have a debit to distribution expense for 212 million, heavily decreasing equity, a credit to intercompany payable for 212 million, increasing liability. When you add this to other intercompany charges like 130 million for advertising on studio-owned network and interest on that initial production loan, the massive revenue is completely wiped out. So is this financial portrayal accurate? Legally and contractually, yes. The journal entry balance and they follow the strict definition of net profit buried in the stakeholder contracts. However, economically, it is highly distorted picture. The flaw is looking at the subsidiary in a vacuum. The expenses destroying the subsidiary's equity and are simultaneously being recorded as pure revenue on the parent company's books. To correct this and see the true economic reality, an analyst must look at consolidated financial statements, which eliminate this intercompany transfer and reveal that the overall corporation made hundreds of millions in profit. Ultimately, this case study proves that financial statement can be technically accurate while still obscuring the truth. Whether you are managing a project, analyzing data, or negotiating a contract, understanding the flow of data between corporate entities is essential for true visibility.